Welcome everybody to the Ellsworth Advisors monthly update for the month of February. Today is March 4th, 2020. And as usual, we'll start off with a little economic and recent headline update with Cameron. I'll go through how the markets have fared, how our portfolios have done, and kind of dig into the topic du jour, which would be the coronavirus and how that's shaking the world right now. Yep. Cam, lead us off.
Thank you, Kelly. Yeah, I mean, obviously no discussion of the markets would be relevant without a discussion of the coronavirus. And, at the end of the day, it is the dominant headline in this 24-hour news cycle that we have. I mean, it's all coronavirus all the time. And I think, what we have to remember is the U.S. economy is strong. The world economy is improving. If you look at the history of the financial markets, this ultimately looks like it's going to be a blip. However, it's a concern. It's headline risk. This is a new, outbreak strain of influenza. There is no vaccine for it yet. We live in a very flat world. There's international trade. There's international tourism. You can spread a disease very quickly. And, world governments have responded. G7 came out and said they're going to continue to support the market. The Fed has cut the Fed funds interest rate by 25 basis points. So it's something that's on everybody's radar. And, the fact of the matter is that global trade is going to be down. China, the world's manufacturing engine. You have shut down plants, you have quarantined population, you have a lack of raw materials going into the country, you have a lack of fixed products coming out. So global trade, tourism are definitely going to be affected. I think we're going to see a ripple of this in corporate earnings in the first and second and maybe even in the third quarter. But ultimately, for all of us old enough to remember, I'm just going to go back through the litany of these influenza strains we've had. 2002, SARS. 2004, avian flu. 2005, West Nile virus. 2009, swine flu. 2013, MERS. 2013 again, there was an Ebola outbreak. 2015, Zika. 2018, another Ebola breakout, and 2020, we've got coronavirus. The fact of the matter is right now, if you look at the U.S., the 2019-2020 flu season is expected to cause 18,000 deaths in the U.S. That's the influenza, the standard flu that we get. Worldwide, 450,000 fatalities are expected from flu. So ultimately, this is a challenge, but just like SARS, the avian flu, I do expect that the governments are reacting, very aggressively, quarantining people, working on vaccines. Ultimately, I think this is going to pass into history like all these other issues. And the last thing to think about, unfortunately, is if you look at the World Health Organization's website, currently we have outbreaks of cholera, meningitis, polio, measles, yellow fever, typhoid fever, and botulism around the world. This is what happens. It's a headline risk. It's, disrupted the markets, but fundamentally, the world economy is in pretty dang good shape. And we just have to remember that, but be prudent because equities are volatile, yields are very depressed, and commodities have been weak. So finding, places to invest money other than putting it under your mattress, it's tough right now, and there's going to be some volatility. So, not what I want to report on, Kelly, but that's kind of where we're at.
Well, just to add a couple things to that, the reality is going into the end of the year, and in January we saw this on our last call. That's kind of when the coronavirus just started rearing its head. The market just started pulling back at the end of January, but the market had run a lot into the end of the year. Valuations were definitely getting a little stretched. Hate to say this, but we were due for some sort of market correction. And
it's a great excuse for people to take chips off the table.
Yeah, this was probably a good impetus to get the correction that we were probably due for. So now we're 13% off the highs. Last week was just a pretty much one direction week, and that really looked a lot like a lot of deleveraging, hedge funds, individuals, basically paying down margin debt and so forth. So you had a lot of deleveraging last week. That's why you had such a, drastic sell-off with really no breaks throughout the week. This week, obviously, we bounced back on Monday. But I think this heightened volatility is going to be with us well into earnings season. When we get into mid-late April, when earnings season comes, going in there, we're going to have the big swings up and down every day. Yesterday, we saw big swings yesterday. Today, the market's looking like a big open. Some say it's based on the Bernie Sanders weak showing and Biden's stronger showing in the Democratic primaries. The fear there was if you get a socialist in, that's going to be detrimental to the economy. And the fact that Biden did so well, the likelihood of a Trump-Sanders showdown is looking less likely, which means less likely we'll have a socialist. So that takes one of those risks off the table. So that probably helped ease, and that's why, a good chance why we're showing some strong upside in the morning. But then again, the market hasn't even opened. We have all day to see reversals. So this heightened volatility is going to be with us. Like I said, until we get into earnings season is not going to look good because one, you're going to probably have a little less activity in Q1, but also this is going to be a good excuse for companies to basically, now's a good time to bring out any bad news you have financially as a company or operating issues you have. They call it kitchen sinking it.
Yep.
They're going to do it this quarter.
You brought up that point yesterday. I thought it was a very strong point is, if you're a public company right now and you've got any skeletons in the closet, any accruals you want to get rid of,
throw them out there now.
Throw them out there now and say,
exactly.
Hey, blame it on coronavirus and a lack of global manufacturing and start over with Q2.
But that also sets the stage for improvements going out throughout the year.
Yeah.
Second quarter, third quarter, fourth quarter earnings. So I think that sets a good stage going into the end of the year or second half of the year. Downside wise, I don't, this is personal opinion. I don't think there's much more to the downside from what we've seen at this point. Just I think there's going to be a lot of chop between now and the end of the year. So let's dig into what's happened in the markets. So if you remember last month, things were kind of flat, slightly negative because the whole Corona thing just started coming to full steam by the end of January. But in February, or the S&P 500, in February, the S&P was down 9.63%. And once again, this is through the end of February. So through the end of February, the S&P down 8.27%. That doesn't count Monday's big rally, which was a 5% rally. So right now, the S&P's not down that. The S&P is probably down more in that 4 to 5% range. The Dow Jones in February down 11.54%. Year to date down 10.96%. On the international front, the developed world measured by the EAFE down 9.94 for the month. For the year down 11.16%. Emerging markets, which actually fared the best in February, only down 8.73%, down 9.79% year to date through February. All that data is through Y charts. I have to disclose that. Now for our portfolios, how did our clients' money fare in our in our largest portfolios? Growth with income portfolio in February we're down 4.71%. So. A little less than half of what the markets were, so fairly happy with that. Year to date, we're still down 5.48%. In growth with income, and this is just for the month. We actually did have we had one big winner for the month. Nvidia was actually up 14.3%, so that's our shining star in growth with income. Our Treasury fund or our Treasury ETF up 0.23%. So those were the only winners in growth with income. On the downside, American Express got hit pretty hard, down 15.35%. Disney, which no surprise, being a place where you're gonna have a lot of people coming in, and you're definitely we saw some closings in Asia, their Asian parks. So Disney was down 14.94%. We had a great run last year, so we're just kind of giving up some gains there. Cisco down 13.14. CVS, this was a little surprising. CVS down 12.74. A little counterintuitive. You would have thought, if somebody's going to benefit, it'd be drugstores, but obviously not. American Express had a big bounce back. Disney had a big bounce back. Cisco had a big bounce back on Monday. So, those numbers, like I said, are just for the month. Price potential, our all-stock growth portfolio for the month down 8.16, so that was able to outperform the S&P and the Dow. Year to date down 8.22. In there, once again, being an all-stock portfolio, a little bit more aggressive. We had one winner in there. Laboratory Holdings Corporation up 0.17%. So we eked out a little bit tiny gain there. On the downside, not huge. Fidelity National Financial down 13.3, Medtronic down 12.79, and Genpact down 13.12. So not huge downside there. We had bigger downside in the price potential, but once again, it was a pretty brutal month. No real winners. Dividend yield down 8.93 for the month. Year to date down 7.96. Actually, we had nothing positive besides our cash position in dividend yield. Utilities got hit kind of hard. Con Ed down 15.47. Southern Company down 13.4 now, or 4.9. Intel, once again, our tech companies got whacked pretty hard, down 12.73. Once again, that rebounded well on Monday. Boeing, once again, travel related, but also Boeing's had its issues, down 13.04. And then Prudential down 16.18. So, once again, tough month for dividend yield, tough month for everybody. In our small cap portfolio, down 8.41 for the month. Year to date, down 5.98. So actually hanging in there well, just because it had such a strong January, less international exposure. Small caps lagged. They really started coming, building steam at the end of the year. So they've hung in there pretty well. This month, we actually had some big winners in here. Ameresco up 17.46 for the month. Red Violet up 13.39. EverQuote up 10.71. So we had some decent winners in there. On the other side, once again, because they're small cap stocks, you have a lot bigger swings. CyberArk down 24.26, LifeVantage down 27.29, Corvell down 24.71. So, one thing you see, techs got hit pretty hard. I think because techs were probably had run up the most. They did rebound a lot on Monday. Healthcare didn't hang in as strong as I thought as they would have through a health scare type situation. But, once again, we're in the height of high volatility. If we saw numbers through Monday, like I said, we pulled a lot back Monday, but the choppiness is going to be with us for, I think for several weeks here going forward. Haven't made any major changes. I think our focus on quality is important.
That's the best point, is we're not focused on the market like a mutual fund. We're not sitting on 500 to 1,000 stocks that are going to be very volatile and go up when the market's up and down when the market's down. We're going to have our pain points, but always we're focused on the individual companies, and the fundamentals of the individual companies, don't change because of a global pandemic. And it's proving out in your portfolios that we're down, less than the market.
Right. Yeah, and I definitely have some concerns. Like I said, I'm optimistic looking into the end of the year, second half of the year. We don't know the long-lasting effects or the longer-term effects of this. I'd say with the Fed lowering interest rates, I don't know if that comes back to bite us at some point. I don't think, in personal opinion, that probably wasn't the most effective tool. And just to do it to soothe markets, probably not the best reason to lower rates. I think there's going to be continued coordination through the rest of the world with whether it's monetary easing. I think we're going to see a lot more fiscal stimulus. Obviously, China's been, pumping the cash in, putting money.
We have to get out of these low interest rate environment.
Right.
And this is not good for the long term.
Unfortunately, that's not going to come until we're done with the cycle.
Yeah.
Will this accelerate the cycle, get us closer to the end? Possibly. We probably have, one big run up in the market. Could it be after this recovery? And, we're closer to the end of the cycle than we are to the beginning. And, it's just a matter of, so I'm more heightened on, okay, as the landscape changes, this makes the first quarter look a lot mushier. It's going to be harder to gauge where we're really at economically until we see things clear over the next couple of months, how much effect did this have. But moving forward, we're definitely late stage, and that is high on my mind in how we're structuring the portfolios, in dealing with individual clients, making sure we have cash available for monthly needs and so forth. That's really been the focus at this point in time. So that's where we're at as of March 4th. We do want to shout out to Tim Klepper for his birthday today.
Happy
He's a whopping
birthday, Tim.
45 years old.
45 years old.
And we'll be talking to everybody in a couple of weeks, and we'll see how things progress.
And last but a note, if you have not refinanced your mortgage yet,
Oh, yes.
please look at it. Now is a great time to lock in a very low and attractive interest rate for which could be a historically low mortgage environment.
Yes, I've resisted looking at mine, but everything is sub 4%.
Yep.
Mid-low threes. Yeah, if you're above 4, definitely consider refinancing.
If we can help you, let us know.
Thank you, and have a great month.
Thanks, everybody.